Welcome to This Explainer. Today we're diving deep into Paychex, breaking down exactly how this company operates as a mature, wealth compounding machine. Let's get right into it.
We're not just looking at some legacy software company here. We are analyzing a literal pillar of the American workforce infrastructure. Paychex is a premier provider of human capital management, payroll, HR, and employee benefits outsourcing. To put their sheer scale into perspective, Paychex currently pays 1 in 11 American private sector workers, literally 1 out of every 11. Historically, they've dominated the small to medium-sized business space, but as we unpack the data today, you're going to see that their ambitions and their reach have expanded dramatically.
Now, the truly fascinating part is understanding exactly how this business prints cash. You've got the standard recurring revenue streams, primarily management solutions like payroll processing and tax administration, right alongside their professional employer organization, or PEO, and insurance solutions. But pay close attention to the interest on funds held for clients. Paychex effectively acts as a shadow bank. They hold on to client cash before paying taxes, and the interest generated on that massive float is essentially 100% margin, pure profit. It's a pretty brilliant way to make money just by holding on to someone else's cash for a few days.
And recently, their market positioning just underwent a tectonic shift. Historically, Paychex totally owned that 1 to 49 employee demographic. But by closing a monumental $4.1 billion all-cash acquisition of Paycor HCM in April 2025, they radically accelerated their reach into much larger enterprise clients. Looking at the landscape today in August 2026, this move unlocked mid to large enterprises that were previously captured by giants like Workday. So they've expanded their total addressable market well beyond $40 billion in the US alone. Massive expansion.
So, what does this all mean? When you look at this expanded scale, you quickly realize it creates a powerful, heavily fortified economic moat. The human capital management space is basically an oligopoly at the top, and Paychex defends its territory through incredibly high switching costs. Think about it. Once a company integrates its payroll, 401k, and benefits administration with the Paychex Flex ecosystem, ripping it all out is costly, time-consuming, and honestly, operationally dangerous. Add in the massive data advantages of processing millions of paychecks alongside that shadow bank interest rate optionality we just discussed, and you have a nearly impenetrable business model.
When we examine this free cash flow machine's financials, the impact of those strategic moves becomes undeniably clear. Just look at the fiscal year trends. Total revenue steadily marched upward from $5.01 billion in FY23, but look closely at FY26. We see a massive jump to $6.51 billion. That is a 16.9% year-over-year top-line bump, driven directly by the inclusion of a full year of Paycor integration. Meanwhile, diluted earnings per share grew by roughly 6.7% year-over-year to $4.89, proving that even with this massive acquisition, bottom-line growth absolutely remains intact.
Now, if there's one single financial metric you should take away from this that truly highlights their efficiency, it's this number right here, approximately 50%. That is Paychex's current return on equity. It's a truly exceptional figure. It proves that Paychex requires very little tangible capital to actually grow its operations. Their operating cash flow sits at roughly $2.55 billion for FY26, and their cash conversion efficiency is just so elite that management can comfortably fund multi-billion-dollar acquisitions while simultaneously rewarding their shareholders.
However, digesting a $4.1 billion company is going to leave a mark, right? While their underlying adjusted operating margins remained highly robust in FY26 at about 40.2%, there is a noticeable compression in net margins, which dipped down to 27%. But actually, this wasn't a surprise at all. It was heavily anticipated by the market due to the amortization of intangibles and the high integration costs related to that Paycor deal. The underlying core business, still as profitable as ever.
Okay, so we've established that Paychex is an elite cash-generating machine. But any thorough analysis requires us to flip the thesis. We have to ask, how resilient is this $2.5 billion operating cash flow engine if the broader macroeconomic environment turns against them? What are the actual material red flags that could disrupt this oligopoly? Let's take a look.
The very first place we need to look is the balance sheet. Paychex historically operated with almost zero debt, which gave them immense flexibility. But to fund that all-cash Paycor deal, they issued a massive $4.2 billion bond offering, bringing total debt to around $4.6 billion today. So the balance sheet is the most levered it's been in decades. But hey, context is everything here. With roughly $1.14 billion in cash and equivalents on hand, their net leverage ratio sits comfortably around 1.3x.
For a company with their kind of cash flow, this debt load is easily manageable, provided execution remains sharp. Now, the most immediate existential threat to that stability is a severe U.S. recession, and it all comes down to their billing model, Paychex bills per employee. It's a very simple equation. If the broader economy contracts and small to medium businesses are forced to lay off workers, or worse, go completely out of business, Paychex suffers immediate top-line revenue attrition. Fewer workers on client payrolls instantly equals lower revenue for Paychex. It's a direct reflection of Main Street's economic health, and it's something to watch closely.
Then there's the interest rate threat. We talked earlier about that incredibly lucrative shadow bank float, right? Well, that pure profit engine relies heavily on elevated Federal Reserve interest rates. If a recession hits and the Fed is forced into a sudden pivot, slashing interest rates back down to near zero, well, that would essentially wipe out hundreds of millions in high-margin profit overnight. It's really a dual-edged sword here. A recession hurts their core billing, and the typical monetary response to a recession hurts their flow.
Despite these macro risks, the market still prices Paychex as a premium asset, currently trading around $120 per share. But when we look at the broader valuation landscape, with a trailing price-to-earnings ratio of roughly 24.5x, they're actually trading at a historical discount. Remember, they often traded at 28 to 32 times earnings during the zero interest rate era. Relative to peers, Paychex is cheaper than the industry giant ADP, which sits at 27x, though it does remain slightly more expensive than a battered cloud-native growth stock like Paylocity, which is down at 18x.
But when you combine that reasonable multiple with a highly attractive dividend yield of roughly 3.8 to 4.0%, the investment profile really transforms. Because of this high yield, the safety of the payout, and their impressive historical dividend growth rate, Paychex is an absolute staple in dividend ETFs, like the wildly popular SCHD. This dynamic is absolutely crucial because it ensures a constant passive bid support flowing underneath the stock, which really cushions it against massive drawdowns.
And that passive ETF flow, it's bolstered by massive, active institutional ownership. Heavyweights like Vanguard, BlackRock, and State Street command huge positions here, providing deep stability. Technically speaking, the stock is currently attempting to build a base above its 200-day moving average, with incredibly strong support firmly established in that $105 to $108 zone. Even though the options market is currently pricing in slightly elevated implied volatility of around 30%, and despite some expected post-M&A insider selling, that institutional bedrock keeps the stock grounded.
Looking past the current macro turbulence and those integration costs we discussed, the long-term growth engine here is highly compelling. The real value of the Paycor acquisition isn't just cost-cutting, it's the cross-selling synergy. Paychex can now upsell its highly robust insurance and retirement advisory services to Paycor's much larger mid-market enterprise clients. On top of that, they're rolling out AI-driven analytics to help clients predict employee churn and automate complex compliance. And their PEO model, where businesses completely outsource all their HR liability, remains a reliable double-digit growth engine that insulates clients from constantly changing employment laws.
So, depending on how well management executes those synergies and what the Federal Reserve decides to do with rates, our discounted cash flow estimations provide some really clear guideposts. In a bear case scenario where U.S. employment contracts and rates are slashed to zero, fair value drops to the $95 to $100 range. However, our base case, assuming 6 to 7% organic growth and normalized margins, puts fair value at $135 to $140. And if synergies exceed expectations and rates somehow stay elevated, our aggressive target pushes all the way up to $145 per share.
With all this in mind, balancing this massive enterprise expansion against the mechanics of their shadow bank float, how should an informed investor actually look at Paychex today? What is the optimal strategy here?
Well, the data suggests a true paradigm shift. Paychex is no longer a hyper-growth tech stock, but a mature, highly profitable oligopoly. For dividend growth investors, the metrics point to a strong accumulation target, serving as an excellent anchor for a defensive portfolio. For pure capital appreciation, it leans toward a hold as the market waits for that debt to clear. The ideal tactical maneuver highlighted by the numbers is a dollar-cost averaging strategy, accumulating shares anytime the price dips below $110, which pushes that ultra-secure dividend yield well over the 4% mark.
Ultimately, Paychex's transformation into an enterprise player makes it an exceptional long-term wealth compounder. But as you consider adding this cash-generating giant to your portfolio, you have to ask yourself one final, absolutely critical question.
Even with their expanded moat and sticky enterprise clients, can their incredibly lucrative interest float truly survive the broader macroeconomic shifts and the Federal Reserve's next major interest rate cycle?